morning to you and welcome to On the Mark. Alongside Mark Pappa, I'm Gary Byron. Mark Pappa is the president and CEO of Financial Resources Group. They're out of Glastonbury, Connecticut. And you can find him online at www.frplan, F as in Frank, frplan.com. More importantly, he's given something out this morning to the first 5 callers to call him at 860-657-8380. Again, 860-657-8380. It's a $2,500 value, and I'm going to have him explain it because I think he can do a better job than I can. And if you missed any of those points of contact, no worries. I'll repeat it at least a couple of more times before the end of the show. Mark, good morning.
Hey, good morning, Gary.
It's great
to be
see
here.
You. It's great. Always great to see you. How have you been? How's your week?
It's going strong. Very good week.
I'm happy
Not complaining. I mean, it's been a lot of news in the headlines and a lot of things out there. You know, you have the SpaceX IPO and how that's going to impact the index, you know, the S&P 500 eventually and the NASDAQ 100. You have inflation that came out in line with expectations, but certainly not showing signs of going down, which is the whole purpose for the show today. In fact, there was one little bright spot is that the core CPE, which excludes food and energy, only increased 0.02% in April compared to 0.3% consensus among economists polled by Bloomberg. So that's a good sign, but the signs aren't looking good for inflation dropping anytime soon unless we get some rabbit out of the hat with Iranian negotiations opening up the Strait of Hormuz. I think that would really calm the markets. But as of today, bond traders are pricing in another rate hike by the end of the year.
Yeah.
Probably won't happen before the midterm elections, but I think as soon after. If inflation's where it is today, it's very far from that 2% target. I think they're going to have to probably raise rates and squeeze the economy a little bit here.
Well, 2 things come to mind from what you just said. Number one,
this is not just my opinion. I'm hearing it a lot now.
And I've heard that as well. You know, the ceasefire or the potential of a deal. It's like it's every 3 days you hear something. Well, we're a few days away from it, and then there's an airstrike, and then we got to retaliate, and then which we have to, of course. And we're close to it. I've been hearing that we're close to a deal for the better part of a month. I don't know how long you could play that game with Trump before he finally just says, yeah, well, you're Lucy holding the football, and I've tried to kick it one too many times, and you pulled that football away from me, and I'm not going to allow you to do that anymore. The other thing is our new Fed chair, Warsh. Do you think he knows Trump doesn't want the rate, the increase in the rate?
No, absolutely not. I mean, Trump wants cuts, which I think would be inflationary at this point. The economy is very strong, job market. Last jobs report came out very strong, more than expected, which was a big surprise. And the economy underlying is strong, and I think the consumer underlying is strong. We're feeling. I think certain consumers are feeling confident, and then there's others who, like I mentioned in the past, those who are living paycheck to paycheck are actually feeling not so good. I think Trump's work. I don't think the government can do anything to bring down affordability until we can clean up the mess and what's going on in Iran right now. And then once that happens, then we can get back to the trajectory we were before, which was falling inflation, higher economic growth. And, the one big, beautiful bill was a massive stimulus to the economy. And we're starting to see it. The wheels are starting to hit the pavement on that. So if we can just get rid of this issue with Iran and clean up the economy, clean up what's happening there, I think we'll be in very, very good shape, bring down energy prices, and I think we'll be in good shape over the next couple of years.
Mark, give us the big picture here. Why are you waving a caution flag on bonds right now?
Well, Gary, as part of our full checklist review, we're always waving a cautionary flag on bonds. So I wanted to talk about that today. But I think the urgency is, at this point in the game, if the bond traders are anticipating a rate increase, not a rate cut, not a do nothing, a rate increase that does have impact on bond yields. So I'd like to talk about that today because most people think bonds as a safe part of their portfolio. You have stocks and have bonds. And historically, in many environments, that's been true. But there is a fundamental relationship between interest rates and bond values that works against you in a rising rate environment. And right now, with everything happening at the Federal Reserve, that environment is very much on the table to increase interest rates. And we need to talk about that, because if interest rates go up, and we do this exercise called interest rate volatility as part of our full checklist review, we go through a whole exercise on fixed income and bonds and how much money you can actually lose if rates were to rise just as small as 1%.
Wow. Okay. So then let's start at the foundation. Walk us through the mechanics. For example, how do interest rates and bond prices, how do they actually interact?
All right, that's a great question, and it's something that we all now know more than 90% of the people walking on the street.
That's why I asked.
Sure. So think of it this way: when you buy a bond, you're essentially lending money, and in return, the bond pays you a fixed interest payment called a coupon. Okay. Mm-hmm. Now, for a set number of years, and so if I'm going to buy a 5-year bond, then it's going to pay me, the coupon for 5 years, and then I'm good to go. So hopefully, if I buy that bar as a new issue, I buy it at par, which is $1,000. I'll get my 5% interest rate for 5 years. At the end of 5 years, I can cash in my bond, and that's it. Now, if rates are at 4% at the end of that 5 years, then I buy a new one. I'm only going to get 4%. But so at the end, you get your principal back. Now, there's the critical piece. Bond prices and interest rates move in opposite directions. And so don't dividend stocks, by the way. So don't even be fooled by dividend stocks, but they're interest rate sensitive as well. But bonds go up. So if bond prices, so we do this exercise, we call it the teeter-totter. And we say, well, if bond prices go down, what happens to the price, what happens to the interest rate? So bond prices, so what happens is if you have bond prices, or let's say interest rates go down, bond prices go up, right? And then teeter-totter. Then I show them, well, if interest rates go up, bond prices do what?
Go down.
Go down. There's an inverse relationship. And that's something people need to know, and that's the iron law of fixed income.
All right. So give me a concrete example of this, though.
Okay. Absolutely. So let's say you have a 10-year bond today at $1,000, and it pays 4%, a 4% coupon. That's $40 a year. Now, imagine rates rise to 6%. New bonds are being issued paying $60 a year, right? My bond's paying $40.
Yeah.
You can go to the bond store or brokerage firm and buy your bond and get $60 a year per $1,000. Why would anyone pay you $1,000 for your bond that only pays $40?
Right.
Right. When they can just go to this, get their own
they wouldn't. Right.
At 40. So this wouldn't. They wouldn't do that. Now your bond has to fall in price, perhaps to around $850 or lower, until the yield is competitive with the new bonds. So you have to discount your bond, sell it, because that'll equal the same interest rate. Does that make sense?
Okay, gotcha so far. Yeah.
Yep. The price drop is a real loss in your portfolio, and the opposite is also true. If rates fall, your bond becomes more valuable. And this is what I want to chat with people about. Call me for the checklist review. Bring in your bond funds. Bring in your growth and income funds, because we're going to find certain bonds that are a lot more risky than others. And I'm not just talking credit quality. I'm talking about for interest rate volatility.
This is why your checklist is so detailed. It's so comprehensive. I'm going to have you go into more detail more towards the end of the show. And that's why it's worth over $2,500 for your time and expertise. But what amplifies this risk? I mean, is it the direction of rates, or I don't know, is there just more to it?
No, there's more to it. So duration is the amplifier. So the longer the maturity of your bond, the more sensitive it is to interest rate changes. So I'll bring you back to 2022, and when the Fed did those very, very aggressive rate hikes to kill inflation from COVID, the 30-year Treasury lost like 30% that year. So if you owned a 30-year Treasury, and you saw a bunch of banks blow up too, who also owned a whole bunch of 30-year Treasuries, if you owned those bonds and you needed to get out of them, you'd have to sell them at a massive loss. Okay, which is why the banks can't do it. They're called held to maturity assets, and they don't have to report the loss on their balance sheet until they actually realize it. So it's kind of interesting. Okay. But anyway, that's accounting. We won't get too deep into it. But a bond with 2 years left to maturity barely flinches when rates move, but a 20 or 30-year bond can swing dramatically. So if you hold long-duration bonds in your bond funds, which most of them do, in a rising interest rate environment, you can experience equity-like losses while still thinking you're safe. Now, that's the trap.
So how does let's say just like a regular investor, how do they find out how much duration or even maturity risk that they actually have? I mean, I'll ask you, what's your process?
Well, we basically take every fund that you own and we put it into a third-party software. That third-party software is Morningstar, because does Morningstar, are they out there hawking their own funds or their own investments, or are they just telling us the facts? Right,
no, I think they're giving you the facts.
Right.
Yeah.
It's like when we have this exercise, we'll say, if you go to the Ford dealer, what's the Ford dealer going to tell you to buy?
Oh, Fords.
Right. But if you go to the Consumer Reports.
No, they're supposed to be objective.
Objective, right. Now, let's say Ford bought a full-page ad in their paper, and then all of a sudden Ford's Car of the Year. Are you going to ever believe them again? Right. So we want a third party. And I encourage investors to do the same. It's free at Morningstar.com. However, I would encourage people to sit down with me so that we can actually analyze any fixed income in their model portfolios right now. Because, again, if you're taking money out of your account every month and rates go up, you're locking in losses on that bond portfolio that you may not even know. In addition, there's other people where you're a buy and hold investor who understand this, and they're bailing out on that fund, locking in losses. Meanwhile, you're sitting there holding the bag. So you don't want to be in that position. So we want to help people realign that for the current environment.
You talking about what? Were you talking about 8%? 8% loss?
Okay, so how that would work?
Because I'm looking at this chart that you have here in front of me here. I'm just trying to make heads or tails of this.
All right, so let me explain this. So what Morningstar will do is basically you'll see that there's two critical numbers: average effective duration.
Right, I'm looking at that.
Okay, so we're going to be a little geeky here.
I know it's radio. It's hard. I'm looking at a graph.
Average effective duration and average effective maturity.
Yeah.
Duration tells you in years how sensitive the fund is to a 1% move in interest rates. So a simple 1%. So a fund with a duration of 8 means if rates rise 1%, the fund's value falls approximately 8%. That's not trivial.
No.
So that's the whole bond fund, by the way.
Yeah,
so that's the blended version. But then there's other bonds what would make that 8% go down, are the ones that have anything more than like a 15, 20, or even 10, 15, 20, 30-year maturity. Those are the ones that can get really hit in a rising rate environment. The ones that are in the 3 to 5s, those are going to be fine because, even if I'm losing money on my 5-year, can I wait a couple of years before it matures?
Oh, look at this.
I don't have a problem, right? But you have a problem. If you're retired, do you want to wait 30 years for your money to come back so you can use it to go to your Disney cruise? Or you're going to have to lock in a loss to pull the money out, right? Think about that.
So, all right, is there a particular duration range that you consider safer, especially in this current environment?
Yeah, absolutely. So when we had our last investment committee meeting in April, and because what I saw with Warsh wanting to steepen the yield curve, this is before that hot inflation print, by the way. We did the trades before that hot inflation print thankfully. We bailed out of any bonds that are long-term bond positions. The one that we kept has a hedge on it, so we're not worried. But we took 20% of our long bond exposure, and I moved that all to short term, and it turned out to be a great move because we got out just in time because I was afraid a steepening yield curve would hurt our long treasuries in our portfolio, and I said there's no point in being long treasuries unless we anticipate a rate cut, which we know is way off the table. And I certainly didn't fall for the trap saying that the Fed was going to cut a lot this year because I've been higher for longer. I've said this for the last 4 to 5 years. We've been inflation hedged, whether it be gold and silver in 2020 or 2021 or 2022 when we invested in our inflation hedged index fund. We've had it in our portfolio the whole way, and we believe that inflation was going to be sticky. Once you let the genie out of the bottle, it's hard to put it back in.
All right, before we went to air, we were talking obviously off the air, and you were mentioning something to me about bonds hiding inside funds. I don't know if I said. Do I have that right? Tell me about it.
Okay. Well, in that case, this is one of the most underappreciated risks out there. A lot of investors own what are called blended or balanced income funds. So you go to your advisor, and the advisor does your risk tolerance questionnaire, and you say, okay, I'm a 6 out of 10. So they're going to say, okay, we're going to put 60% of your money in stocks and 40 in bonds, and all the research says, hey, this is the way to go. So you get one of these balanced funds in your portfolio or in your 401k if you tend to be a little bit more conservative, or even your target date fund, which I've seen tend to be a little bit more risky than advertised, but that's a conversation for a different show. But funds that hold both stocks and bonds, now that might be marketed as a moderate risk, income-oriented, all-weather strategy. But the big problem is what investors don't realize is that the bond portion of those funds can carry significant duration risk.
So you think you're diversified, right? But the bond component is actually a risk multiplier.
It can be in a rising rate environment, precisely. The classic 60-40 fund, 60 stocks, 40 bonds, if that bond sleeve has an average maturity of 15 to 25 years, and that's what Morningstar helps us do. It helps us break down what percentage of your bond portfolio. So if I have $1 million account and $400,000 of my money is in bonds, right? Because that's the 40%.
Right.
And then I have a whole of that piece, there's 15 to 20 or 30-year bonds in that portfolio, and we have we have interest rates going up. That is not going to cushion your losses. If anything, it's going to add to them. And at the same time, your equity portion may also fall because rising interest rates pressure stock valuations, particularly growth stocks, which are dominating the market right now. So you have to be really, really careful, and you get hit from both sides simultaneously, kind of like we did in 2022.
So how do you check on this?
Well, again, for Morningstar, we basically put the tickers in, and then we print out a report. You can do an X-ray or a snapshot, and it will tell you the split between stocks and bonds and cash. And then it'll also look at the stats that I just described, duration and maturity. And if the duration on the fixed income sleeve is 7, 8, or 10 years or more, you want to have a conversation with your advisor about whether or not that level of rate sensitivity is appropriate for you. Because again, if you're retired, do you want to wait for your bonds to actually mature, or your bond or interest rates to get cut before you take that Disney cruise or go down that family trip to Greece? That a lot of wherever you go, Europe. Are you going to wait around and cancel your trip, or are you going to say, oh, you're going to have to pull the money out? Now you've just locked in a loss. And locking in that loss, it could be fairly substantial. Right. And that just, it's a bittersweet trip at that point.
Folks, you are listening to On the Mark, along with Mark Pappa. I'm Gary Byron. Mark is the president and CEO of Financial Resources Group throughout Glastonbury. You can find him online at frplan.com. And here's the number that you should be calling. The first 5 callers this morning, they're going to get a $2,500 value of this completely thorough checklist. It's beyond a checklist. It's really protocol. 860-657-8380. I'll repeat that more towards the very end of the show. Mark, let's talk about the Fed for a moment. I teased this early at the beginning of the show. Kevin Warsh, now the Fed, the chair. What are his stated goals here? Because, maybe I should ask, why do these goals even matter for specifically for bond investors?
Well, this is what scared me initially, Gary. This is what really triggered my gut. I have a lot of experience. I've been doing this since 1995. And I was green then, but I'm not green anymore. I have to say that what scared me most was Warsh's intentions. And they are, and I like what he's going to do, reduce the Federal Reserve's balance sheet and get interest rates to a more normalized level and keep inflation on a credible downward path. But that's an extremely difficult thing to do in this environment. And I think the game has changed on him, and he's going to have to figure out a different direction. But those are hurdles those are barriers, hurdles, whatever you want to call it, to the path that he wants to create. But those are the reasons why we made those decisions back in April when we changed up our bond portfolio. And the other reason is, what doubled down on our conviction was the fact that, thankfully, after the fact, that we saw inflation come in hotter than expected. So, but those are things, they're all interconnected, Gary, and they have 3 implications for your bond portfolio.
Oh, let's take them one at a time. Let's look at the balance sheet. So what is the Fed's balance sheet, and why does reducing it even matter?
Well, during the COVID era, and frankly going back to 2008, the financial crisis, the Federal Reserve's engaged in what's called quantitative easing, or QE.
Okay.
So that's what QE means, quantitative easing. They bought trillions of dollars of U.S. Treasury bonds and mortgage-backed securities. At its peak, the Fed's balance sheet swelled to nearly $9 trillion, Gary. And what that did was inject liquidity into the financial system. So as the Fed balance sheet grows, you get money supply increases. Really simple, M1, M2. M2 is back to almost near where it was at COVID time, which is kind of scary because more money, you have too many dollars chasing too few goods, and guess what that creates? Creates inflation. So what we did was we injected liquidity into the financial system to support it, suppressing long-term interest rates and propping up asset prices, things like stocks, bonds, and real estate, all of it.
And now what? Warsh wants to reverse that, right?
Correct. He wants the Federal Reserve to go back to what its initial job was back to its core. The process of reducing the balance sheets is called quantitative tightening, or QT. And the Fed lets bonds it owns mature without reinvesting the proceeds, which effectively removes money from the financial system. So it's a version of tightening, no different than raising interest rates. So my theory here is maybe they don't raise rates, but they announce that they're going to start to tighten. That could still have impact on your bond portfolio. See what I'm saying? So even if the Fed decides not to raise rates towards the end of the year, they could announce a shift from easing to tightening in order to reduce the balance sheet, which essentially is like a rate hike without hiking rates. So it's psychological. So that they have psychological weapons as well. They don't just have monetary weapons. And the monetary tightening, it puts upward pressure on long-term interest rates. Again, if you have long bonds, that means interest rates on your long bonds go up. Guess what happens to the value? Goes down, right? So because of the Fed is no longer an artificial buyer in the Treasury market. So now, basically, when the largest buyer steps back and prices fall, as we all discussed, falling bond prices means, obviously, rising yields, which is bad.
QT, if I'm understanding this correctly, is essentially the mirror image of what propped up bond prices for, over a decade?
Yeah, I mean, during COVID, we were there's data going back 5,000 years on bonds, but realistically, we're at all-time lows, historical lows. And that's pretty bad. So then that means when they go to reverse it, look what happened is, people on the long side lost 30% of their money.
I don't know if it was last week, but I know very recently, it could have been our last episode. We talked about the concept of sticky inflation. Remember? The idea that once you let inflation out of the bottle, it's very hard to put back in. Yep. Just remind people about that and how it actually connects to really what we're seeing today.
Well, it really connects to making it very difficult for the Fed to cut interest rates to stimulate the economy. So we had a lot of fiscal stimulus with the OBBB, the One Big Beautiful Bill. So in the prior administration, we had a lot of fiscal stimulus as well, and we had low interest rates, and we had inflation was horrible, right? Wow. So that's and it's still sticking around because again, policy moves a lot slower than inflation, which is the problem. And it also moves a lot slower than economic growth. So yes. So when you take a look at the theme coming back to that, because it is so critical, history teaches us going back to the 70s under the Fed chairs. It was Arthur Burns at the time, and then the inflation fighting Paul Volcker.
Yeah, I remember him.
Yeah, that inflation is not like a light switch you can just flip off. Once inflation becomes embedded into the expectations of businesses and workers, again, it's expectations too. Once people start pricing in higher inflation into the wages, the contracts, rent increases, it feeds on itself, and the genie is out of the bottle at that point.
I need you, I've only got about two and a half minutes remaining. I need you to do two things before we wrap things up. Can you do your disclaimer and then talk about that $2,500 value to the first 5 callers? You have an incredible checklist but it's more comprehensive than anything that I've ever been exposed to. This is worth its weight in gold.
And I will. So the information presented for this program is educational, or is for educational purposes only, and should not be considered personalized investment advice. Financial Resources Group, LLC, is a state-registered investment advisor in Connecticut. For more information about our firm, service, and fees, visit or just go to frplan.com or request a copy of our Form ADV, which contains important disclosures about our businesses, qualifications, and potential conflicts of interest. Investing involves risk, including the possibility of loss of principal. Always consult a financial professional before making investment decisions.
You got a $2,500 value right now, the first 5 callers. I'm going to give you the number in a second. Why should they take you up on this? This is an incredible offer.
Well, Gary, because it's just a thorough scrubbing of your financial and your non-financial aspects of your financial plan. Next week, Gary, we're going to be talking about insurance and what the insurance companies are doing to people, how they're denying claims, they're raising your instead of raising premiums, they're finding little known. So we're going to be talking. That's part of our financial review. We want to look at your power of attorney. Just so you know, you can Google this. Your power of attorney does not work with Social Security. So God forbid your Social Security got gummed up, or you had a problem or identity theft. trying to turn that back on is next to impossible. The Social Security Administration, it's been documented, accidentally kills via keystroke up to 12,000 people a year. And God forbid that were to happen to you. You think it's easy to get that back on. If you have somebody who's handling your affairs for you, it is extremely difficult. And now they actually added another form that you need to fill out to get that person improved before you can even fill out the form to become somebody's representative. So it is getting a lot harder to do things, but we need to be ahead of this curve. That's what the full checklist review will do. So think about this, at $2,500 value, what happens if you missed 4 or 5 Social Security paychecks and your Medicare got shut off at the same time for 3 to 4 months, or maybe even longer? How much money out of pocket would you have to pull from your bank accounts and your brokerage accounts to pay those bills until you can get your Medicare and your Social Security corrected?
Oh, I never thought about
so
that.
$2,500 is what a pittance compared to that.
Yeah.
So that's exactly, and we do this now. We don't get paid to do the non-financial stuff, but guess why we do it, Gary?
Well, you're ethical.
Right. It's just the right thing to do.
It's the right thing to do.
Yeah, we don't get paid to do this stuff, but that's why we do it.
And this is why people who, when they come into you, I hear back, they love you. People who have actually, not just the people who've never had a financial advisor, people who've come from other financial advisors, and they, without any prompting from you, without any pressure, they trust you.
Well, let's just think about this before you hang up. We leave the show, Gary. Ask yourself: has your advisor gone through your bond portfolio? Your advisor gone through your bond portfolio, and if they haven't, ask yourself why. Why hasn't my advisor called me with rates going up and inflation popping? Haven't they sat down and helped review my fixed income portfolio? Ask them why.
But you're doing a lot more than I think what a lot of other people out there are doing.
Oh, I mean, I bet you there's advisors that do it. But I would say we're in the minority.
Yeah.
And if you want to be on the same side of the table as you, this is what we do. We're
like
on
you,
your side,
Mark.
not working against you.
Mark, what you're offering are few and far between. Don't be so. You're a humble guy, but take it from me, folks.
Oh, thank you.
Financial Resources Group. You can meet with Mark. His office is in Glastonbury, Connecticut. You can find him online at www.frplan.com. And here's that very important phone number. I want you to call it right now. First 5 callers are going to get that $2,500 value that he was just mentioning. 860-657-8380. Again, 860-657-8380. For Mark Pappa, I'm Gary Byron. Thank you so much for listening to On the Mark. Until next Saturday morning, have a good one, everybody. So long.